Welcome back to Calm Investors. I am Ruth.
And I am Patrick. And Ruth, I have to tell you about my friend Marcus.
Oh, tell me about Marcus.
So I have this friend, let us call him Marcus, who texts me stock tips every single day. Monday, he is euphoric. He is like, Patrick, you have to buy this stock. It is going to the moon. Wednesday, he is panicking. He is like, sell everything, the market is crashing. Friday, he wants to move everything into gold. I never know whether to listen to him or just mute the conversation.
I love this, and I have to tell you something. Patrick, your friend Marcus? He is one of the most famous characters in the history of investing.
Wait, what?
Well, not Marcus specifically, but the character he is playing. Because back in 1949, a man named Benjamin Graham, who is considered the father of value investing, and who was Warren Buffett's teacher, wrote a book called The Intelligent Investor. And in that book, he created an allegory, a character. He called him Mr. Market.
Mr. Market. Okay, tell me about him.
So here is the setup. Imagine you own a business, a real business, and you have a business partner named Mr. Market every single day. Mr. Market shows up at your door and offers to either buy your share of the business or sell you his share, and the price he offers changes every day based on his mood.
Based on his mood, not based on what the business is actually worth.
Exactly. Some days Mr. Market is euphoric. Business is great, the sun is shining, everything is wonderful, and on those days, he offers you a very high price. He is willing to overpay. Other days, Mr. Market is depressed. He is convinced the world is ending, and on those days, he offers you a very low price. He is practically giving his share away.
That sounds exactly like Marcus. Monday euphoria, Wednesday panic.
It is Marcus. Marcus is Mr. Market. And here is the genius of Graham's allegory, the key insight, the thing that separates great investors from everyone else.
What is it?
Mr. Market is there to serve you, not to guide you. You are never obligated to accept his offer. He shows up every day with a price, and you get to decide. Do I want to buy at this price? Do I want to sell at this price? Or do I want to do nothing and just wait for a better offer tomorrow? The choice is always yours. His mood is his problem, not yours.
Oh, that is good. So the stock market is basically Mr. Market showing up every day with a price tag, and most people treat him like an advisor, like his price means something about the value of the business. But he is not an advisor, he is just a guy with mood swings.
That is exactly it. And this is where most investors go wrong. They look at the price Mr. Market is quoting, and they assume that price reflects reality. If the price is going up, the business must be getting better. If the price is going down, something must be wrong, but that is not how it works.
Because price and value are different things.
They are completely different things. And this is one of the most important distinctions in all. Of investing price is what Mr. Market quotes you on any given day. It changes constantly based on his mood. The news, what people are feeling value, is what the business is actually worth. Its earnings, its assets, its future cash, flows, its competitive position. Value changes slowly over time, based on real business fundamentals.
So the price bounces around like crazy every day, but the actual value of the business underneath is much more stable.
Much more stable. Think about it this way: if you own a local coffee shop, and some random person walks in and says, "I will buy your shop for half of what it is worth," would you sell?
No, of course not. That is a terrible offer.
Right, you would laugh at them. But what if the next day, a different person walks in and offers you double what it is worth? You might think about selling. That is how you should think about the stock market. Mr. Market is walking in every day with an offer. Sometimes the offer is ridiculous. Sometimes it is generous. You do not have to accept either one.
But here is my question, and I think this is what a lot of people struggle with. How do I know when Mr. Market is being crazy versus when he is actually right? Like, what if the price is dropping because the business really is in trouble?
That is a great question. And here is the answer that changed how I think about investing. You do not need to know whether Mr. Market is right or wrong. You just need to know your price. What is the business worth to you? If you have done your homework and you know that a business is worth, say, $50 a share, based on its earnings and growth, then it does not matter if Mr. Market is offering you 30 or 70 at 30. He is giving you a bargain at 70. He is overpaying. Your job is to know the value. His job is to offer prices. Those are two different jobs.
Okay. So it is not about predicting what Mr. Market will do. It is about knowing what the business is worth, and then waiting for him to offer you a good deal.
Exactly. And this is how Warren Buffett has used this framework for over 60 years. Buffett has a famous quote. He says, "Be fearful when others are greedy, and greedy when others are fearful." That is the Mr. Market framework in one sentence. When everyone is euphoric and prices are sky high, Mr. Market is in a manic mood. That is when you should be cautious, and when everyone is terrified and prices are crashing, Mr. Market is depressed. That is when the best deals are available.
Be fearful when others are greedy, and greedy when others are fearful. That is so counterintuitive, but it makes perfect sense when you think about Mr. Market.
It does. Because when Mr. Market is depressed and offering you rock-bottom prices, he is not warning you to run. He is offering you a sale. Think about it when your favorite store has a 50% off sale. You do not panic and say, "Oh no, the clothes must be terrible." You say, "Great, I am getting a deal." But when the stock market drops 50%, people panic and sell. They treat a sale like a warning. That is Mr. Market's mood, infecting their judgment.
Oh wow, I never thought about it that way. A market crash is literally a sale on businesses. The same businesses, just cheaper.
The same businesses, the same earnings, the same products, the same customers. Nothing about the business changed. Only Mr. Market's mood changed. And if you let his mood dictate your decisions, you will buy when he is euphoric, at the highest prices, and sell when he is depressed, at the lowest prices, which is exactly what the Dalbar data shows the average investor does.
So the behavior gap we talked about, that is basically people treating Mr. Market as their advisor instead of their servant.
That is exactly what it is, and the danger is real. Because Mr. Market is very convincing. When he is euphoric, he makes you feel like a genius for owning stocks when he is depressed. He makes you feel like a fool, and most people cannot separate their emotions from his emotions. They feel what he feels, and they act on those feelings.
Okay, so how do I actually use this in real life? Like, the next time I see a big market headline, market crashes, or market hits all-time high, what should I do?
Here is your practice for this week. The next time you see a dramatic market headline, market crashes, or market soars to record highs, I want you to pause for 10 seconds and ask yourself two questions first. Is Mr. Market being rational or emotional right now? And second, does his mood change what these businesses are actually worth? Write down your answers. You do not have to do anything with them. Just practice separating price from value. That is the skill.
I love that. Just pause and ask, is this price or is this value? That is such a simple filter.
It is simple, and over time, it becomes automatic. You start seeing market movements differently. A drop is not a disaster. It is Mr. Market having a bad day. A surge is not a celebration. It is Mr. Market being overly optimistic. And in both cases, you get to choose whether to accept his offer or just wait.
You choose whether to accept. That is the power. You are never forced to do anything.
Never. And there is one more question I want to leave you with. Howard Marks, who is one of the greatest investors alive, talks about this. He says the single most powerful question in investing is this: would I buy this at this price if I had never owned it before?
Wait, say that again.
Would I buy this at this price if I had never owned it before? That question strips away all the emotional baggage. It does not matter what you paid. It does not matter if you are up or down. The only thing that matters is, right now, at this price, is this a good deal? If the answer is yes, hold it or buy more. If the answer is no, you have your answer.
That is brilliant because it takes Mr. Market completely out of the equation. It is just you and the value of the business.
Exactly. All right, let us lock in the key takeaways.
Let us do it.
Number 1. The stock market is like an emotional business partner who offers you prices every day. You are never obligated to accept. His mood is his problem, not yours. Number 2. Price is what Mr. Market quotes you. Value is what the business is actually worth. They are often very different things, and confusing them is the most common mistake investors make. Number 3. When Mr. Market panics, he is offering you a sale on the same businesses. When he is euphoric, he is offering to overpay. Neither mood should dictate your decisions. And number 4. The single most powerful question in investing. Would I buy this at this price if I had never owned it before? That question cuts through every emotional bias.
And your homework next time you see a big market headline, pause for 10 seconds and ask, is Mr. Market being rational or emotional? Practice separating price from value.
If this episode changed how you think about the stock market, follow Calm Investors wherever you are listening, and share this with someone who needs to meet Mr. Market.
Thanks for listening, everyone.
Stay calm, build wealth,